Well, I mean, I think this is classically comes from the Patels, right? The Dhando philosophy.
Yeah.
This is how we want to do all our bets with people, with stocks, with everything.
Asymmetric.
Yeah,
side.
basically where we always want to look for things where the odds are so heavily in our favor. So in investing, we do get these anomalies where you take low
What's
risk.
one that you've benefited from, or what's an example in your portfolio or your career investing?
Well, I mean, I think that if I look at my first business, for example, right? I mean, I'm taking 30,000 from my 401k, which I can make up. And at that time, the credit card laws were very different, where if you declared personal bankruptcy, you got a clean slate. And actually didn't affect your credit because you couldn't file again for 7 more years. So everyone would give you money after you filed. Okay, so actually they've changed the laws now. But at that time, I realized that starting a business has high rates of failure, right? And so I said, how do I minimize the risk on that? And this is what all entrepreneurs do. And I said, okay, so basically, if this thing blows up, which there's some probability that could happen. I got my job already. They want to take me back. And I'd also de-risked it because the company was already cash flow positive by the time I quit my job, right? And so there was already a pipeline and such. And so repeatedly what I've found is even in investing, I mean, I'll give you an example. Like, for example, I think in 2003 or 2004, there was a steel company in Canada, IPSCO. And I noticed that they were trading for 3 times earnings, right? The stock was at $45. They had $15 a share of cash on their balance sheet. They had no debt. And they had contracts over the next couple of years where they had said our earnings for the next 2 years are going to be $15 a share each year. These were not forecasts. These were hard contracts, right? So I said, okay, so the stock's at 45. If I just buy the stock and hold it for 2 years, I got $45 cash in the company. Now it was cyclical business. 3rd year could be 0, could be negative. But I said, I own all the plant, equipment, everything for free, right? So I made the investment. I put 10% of assets into IPSCO. And I said, all I want to do is I want to see what Mr. Market does with this stock in 2 years. Just going to hang out and see what happens. We make the investment, and then a year later, the company announces that we're going to have 1 more year of $15. Okay. So now you're going to have 60 versus 45, right? And by now, the stock has kind of gone up and it's sitting at about $90, double in 1 year. So I said, okay, it's still a very cyclical business. Maybe we should take our chips off the table. And while I'm thinking about all that, one day I wake up and the stock's at 155. Some Swedish company came and offered 160 to buy them. 5 minutes later, I sold the company and moved on, right? So what I'm saying is that that's what we're looking for, right? And in the equity markets, because these are auction-driven markets, when you look in areas which are hated and unloved, you will find these anomalies. Last year, for example, I spent about 7 or 8 months studying the coal industry. 4-letter word, hated and unloved, more than anything else. I mean, a lot of endowments and funds are not even allowed to invest in the coal industry. There's so much hatred for it.
So you got excited.
The math was like this. If there's a business that is going to exist for 50 years, on average, it's going to produce $1 billion a year in cash flow that's going to be distributed to shareholders, available to buy for less than $2 billion. Where do I sign? Okay, that was the coal industry. Okay, and so it's like you in auction-driven markets, you repeatedly run into these things where things, there's companies emerging from bankruptcy, there's things that people just don't like, there's different reasons why things get mispriced.